on understanding how the financial statements of a sole trader are actually prepared. So a sole trader is actually a person who starts or who operates a business in such a manner that he's the one who contributes the capital and is actually the one who runs that particular business. So such kind of a business is known as a sole proprietorship. But the person who owns that particular business is known as a sole trader or a sole proprietor. So it is a kind of a business that is owned and managed by a single person. So because it is one person who owns that particular business, the profit from that particular business is actually shared by that particular person alone. Actually, it is not shared, but it is owned by that particular person who runs that particular business. The same case applies to the losses. If losses occur, the same person who owns and runs the business will bear the burden alone. So in the financial statements of a sole trader, we are going to focus on two statements. That is the income statement, which previously used to be known as the trading profit and loss account. And then the other statement is the statement of financial position, which used to be known as the balance sheet. These are the two statements that we are going to prepare under this particular topic. The good thing about the way the topics now that are remaining are arranged is that the moment we finish with the financial statements of a sole trader, we shall go to the financial statements of a partnership, and then we finish with the financial statements of a company. If you are able to understand how to prepare the financial statements of a sole trader, when we go to the others, that is the partnership and the company, you find that it is going to be a slight improvement of this. So this one will form a very, very important foundation for you to be able to understand the other two areas that we are going to discuss later on. So having said that, allow me maybe to explain what these two statements are all about. With the income statement, this statement is normally prepared with the sole intention of determining the profit of the business. You normally prepare the income statement with the target or with the objective of determining the amount of profit the business generated in a particular financial period. So as you can be able to see here, we have the trading and we also have the profit and loss account. So this statement has got two parts that are going to be prepared at the same time, the trading part and the profit and loss part. But generally, the whole statement is known as the income statement. So just note that the income statement is simply meant to confirm or to determine the financial performance of a business in terms of profitability. The next statement, which is the statement of financial position, it is normally prepared by the sole trader so that he can be able to know the financial position. The financial position here, we mean the total assets the business has, the total liabilities the business has, and the difference between the two should give us the capital, as we know from the bookkeeping equation. So this is actually simply meant to know the assets the business has and their values, the liabilities the business has and their values, and also the capital of that particular business. Having said that, we can move now to the income statement and see what it contains. So we start with the income statement. We have said the income statement is normally prepared with the intention of determining the profitability of the business. The format of this particular statement is this. Number one, the statement must have a title. It must have a title. And in the title part, we normally capture the name of the business, We also capture the name of the statement. And lastly, we normally capture the date when we are preparing this statement. So it can be John Trader income statement for the year ended a certain date as you are given in the question. This date, note, always it should be captured in the form of for the year ended, because this income statement is normally prepared at the end of the financial year. So it must be prepared at the end of a particular year, and therefore you note the date of that particular end of the year. So it can be John Trader income statement. So the name of the statement you just capture it is the income statement, and then you say for the year ended 31st December 2019. But the whole of this is going to be provided in the question. So the date is provided, the income statement you will be told to prepare. So the date, the name of the business is also going to be provided. So you capture these three in the title. Having said that, then now you go to the main document and see what it contains. So we have said at the top there, and once you have indicated the title, we normally underline the title. Then you should have 3 columns where you record the amount. Have 3 columns like that. We always start with the sales. Sales, make sure you put it on the far column like that. Sometimes you can sell the items. Remember, sales, it is the amount of money you have received after selling a certain amount of goods. So this is what you have received after selling the goods, the whole of that particular financial year. So you record here the amount. But remember, you can sell some goods and then the customers return them. Some goods can be sold and then the customer return them because of one reason or the other. Either they are expired, they are not of the right size, they are not of the right quality. The customer might return them. Once they are returned, remember they were sold, so they are included in this figure. Once they are returned, then it simply means that those goods have not been sold. So you normally come here and you less or you subtract the sales returns, also known as return inwards. You less return inwards. And then you record the value of the goods that were returned, so that now the total amount of goods or the total value of goods sold minus the value of goods returned, it is going to give you a figure here, which we normally call the net, which is normally referred as the net sales. Those are now the value of the goods that were actually sold. The sales minus what was returned, so that you can get now the value of goods which went to the customers completely. Having obtained the net sales, you normally come here and you say less the cost of sales. Less the cost of sales. I want to pause here and go back here again. Sales, it is the amount of goods or the amount of money that you have received from the goods sold. But those goods which have been sold, they must have costed the business a certain amount of money. So we want to know these goods that were sold and they generated this much that we have here. How much did they cost the business? For you to be able to understand the cost of those goods that were sold, we normally have it like opening stock. Opening stock, make sure you put it on the middle column. Then you add the purchases. Purchases, put it on the first column because it can have some adjustment. So when we are talking about the cost of goods here, remember now here we are actually capturing the buying price. The buying price. So we normally have the opening stock. In a business, you will find that because it is a going concern from the principles of accounting, when one financial year ends, it simply means that the next day, the next financial year is going to start. So whenever a new financial year is starting, you will find that there is some stock that was never sold in the previous financial period. That stock is what you normally start with in the beginning of the new financial period. The stock that you normally start with in the beginning of the financial period, which were never sold in the previous financial period, is what we normally refer as the opening stock. So on the opening stock, we normally enter or capture the cost of the opening stock. This opening stock, they were bought at what price? So the total price is what you put here. Then you add the cost of the new stock that you bought. During the year, you will add more stock. So the new stock that you add to the business is what we are referring as purchases. You put here. The same case that we have here, purchases can also suffer some returns. We can purchase some goods, but because of one reason or the other, the goods can be returned back to the supplier. If the goods are returned back to the supplier, which we had purchased, we normally less. But before we less, let me add something so that we can have all the addition. On the purchases, we normally add what we call carriage inwards. Carriage inwards, it is actually the cost of transporting the purchases. It makes sense this way. If I have purchased goods worth 10,000, and then I use 1,000 to transport them from my supplier to my business, then it can make me understand it like this. If I bought 10,000 worth of goods, I have transported them using 1,000, I can comfortably say that those goods have costed me 11,000. Those goods have costed me 11,000. So the carriage inwards that we normally include here, it is the cost of transporting the goods that you have purchased. Just a minute. Okay. So I was saying this, the carriage inwards, it is the carriage on the goods that were purchased. The cost of the purchases, then you should add the cost of transporting those particular purchases, because that cost of transporting them will not have been incurred if those purchases were not made. So it is a cost that is attached to the purchases. So we normally add it to the purchases. Having done that, we normally less the return outwards. The return outwards, it is the value of the goods that you had purchased, but because of one reason or the other, you don't need them, or they don't actually qualify to be retained because they don't confirm or conform with the specification that you made. So if you return them, you normally less. And in accounting, any figure that you raise, you normally put it in bracket. So that now, this first column here, it is only meant to make adjustment on the purchases. So you have the purchases, you add the cost of transporting them, known as the carriage inwards, then you raise the return outwards, so that now you can get the total or the actual value of the purchases, which you normally come and put it to be directly below the opening stock like this. Then you can now add the value of the opening stock plus the value of the purchases will give you the cost of goods available for sale. That is the opening stock plus what you have purchased. It will give you the value of all the goods that is available for sale. And remember, here we are talking about the cost. When we are referring to the cost here, we mean the buying cost. So you normally have it. So if this is what was available to be sold, this is the cost of the goods that are available for sale, you will realize that at the end of the financial period, what was available for sale, not everything was sold. Therefore, you are going to witness a scenario whereby you have what we call what? Crossing stock, which you normally rest here, like that. So what was available for sale minus what was not sold, it will give you the value of what was sold, the cost of what was sold. So that cost is actually what we are looking for here, the cost of sales. So you come and put it directly below the net sales so that now you can add, sorry, you can subtract, not add. You can subtract from the net sales so that you can arrive to a figure we normally refer as the gross profit, so that you can get a figure we normally refer as the gross profit. Allow me to go through it again. So the gross profit will be here. It is actually to be the net sales minus the cost of sales. It gives you the gross profit. Let me go through this statement again. So we have the sales, which is actually the amount of money you have received out of selling the goods. You record it here. Then you less the value of those goods that were sold but were returned. You less it so that now you can get the value of those goods which were actually sold. If you get the value or the amount that you received from the sales, you less the cost of the goods that were sold here. If this is the value that we received from the sales, then we must ask ourselves, if we have received 1 million, these goods that were sold for us to get 1 million, how much did they cost? So we are looking for that cost for the goods that were sold to generate this figure that is here. So we normally start with the cost of the opening stock, that is the buying cost of the opening stock, plus the additional purchases cost. Then we add the carriage inwards, which is the same as the carriage cost on the purchases. Then we less the cost of the goods that were returned so that we can get the cost of the goods that is going to be available for sale. That is actually the purchases plus the opening stock. If this is available, this is the cost of the goods that are available for sale, but we did not sell this, then the cost of whatever was sold is this. If this is the cost of what was sold, and this is the amount those goods that were sold generated, the difference between the two will give you the gross profit. And this part here, up to the point where we get the gross profit, this is now what we call the trading part. Remember, this statement is used to be called the trading profit and loss account. So this part, up to the point we get the gross profit, it used to be referred as the trading account. So having obtained the gross profit, the statement continues. The statement continues downwards. You need to have it as one statement. So we have gone up to the point where we have the gross profit. So we have the figure for the gross profit there. What we normally do, the gross profit is actually the income to the business organization out of selling the goods. Remember, any business is normally established with the purpose of selling certain items. So the income that comes out of the sale of those particular items is what we call the gross profit. But the business can have other sources of income. A business can have the rentals where it receives some rent. That is actually an income that is coming not from sale of goods. That is known as the other income. So you normally add other income or incomes. And in this case, we normally have things like the rent income or rent received. You add it. Remember, we still had our 3 columns up there. Another additional income can be something like a discount received. It can be something like commission received. Commission received, it is an additional income like that. You normally add this income and include it to the gross profit. And there's one that I've forgotten. There is what we normally call decrease in provision for doubtful debts, the decrease in provision for doubtful debts. You also include it here as a other income, and then you add all the additional incomes so that you can be able to arrive at a figure that you are going to add to the gross profit, so that you can arrive at a figure that you are going to include it here as the other income total, so that you add and get the figure here. Having arrived at that, now you less the business expenses that is not related to purchases. Any other way you can spend the money in the business apart from buying goods, that is purchases. How are you going to have them? We are going to have things like the rent. We are going to have things like the salaries and wages, insurance, electricity. We are going to have the opposite of this, which is decrease. Not decrease, but increase in provision for bad debts, the increase. Then we have got discount allowed. We have got the discount allowed is an expense. We also have the carriage outwards. Carriage outwards is the carriage on sales. If, for example, you have sold the goods and then you offer transportation to your customers, those are known as the carriage outwards. It's an expense to the business. And any other expense that you can have, you add them all here. You put them all here so that you can sum them. You add them so that you can get the total expenses you put here. Now, these total expenses you less from the total income so that you can arrive at a figure here, which we normally refer as the net profit. Sorry, we normally refer as the net profit. But if it is negative, it is going to be the net loss. If you minus this, you find it is negative, then it simply means that the expenses are more than the income, and therefore the business has registered a net loss. That is how we normally prepare an income statement. But anytime you will find this question in an exam, you will always be given a trial balance, and then below the trial balance, you will be given additional information. So you are supposed to use the additional information to make the necessary adjustments. We are just from end year adjustments, so you need to make those adjustments so that now you can be able to know the correct figures you take in this particular statement. Having said that, I think it is going to be in order if we can have a look at some questions which I had given you to do, but which is the best way? Can we have the format of the statement of financial position so that when we start doing them, we do them once? Because some of the questions, they have the two statements combined as one question that was supposed to be done. I think it is in order I give you the format of the statement of financial position so that we can start having some examples on the same. So we have the statement of financial position. And our case here, we are looking at the format. With the format, it will also have a title. Must have a title where we are going to capture the name of the sole trader. Then we capture the name of the statement, which is the statement of financial position. And then lastly, we have the date. The difference between the date format and the date format for the income statement and the date format for the statement of financial position is that for the statement of financial position, the date must be captured as at a certain date. It can be as at 31st December 2019, as at 30th June 2015, like that, but you need to capture it as at. But for the income statement is for the year ended. That is the difference, and you need to have it in mind. Having said that, you proceed to the body part, So this title is supposed to be underlined. Once you have it, you normally underline, and then you go to the body part. So the body part is going to have the following. We normally start with the fixed, also known as nowadays as non-current assets. And make sure you have 3 columns. The first column is to record the cost of that fixed asset. The next column is to capture the accumulated depreciation. That is the total depreciation. And then we are going to have the third column capturing the net book value, like that. So we have 3 columns. The first column, it is the cost, the amount of money that you spend in acquiring the fixed asset. The accumulated depreciation from the time that fixed asset was bought up to the date you are preparing this particular statement. What is the total depreciation? If you minus the cost minus the accumulated or total depreciation, you will get the net book value of that asset as at that particular date. So here we normally have things like the motor vehicle. It's a fixed asset. We have things like the furniture. We have actually land and the buildings, which is supposed to be number 1 here. We also have things like the fixtures and the fittings, machinery, equipments, name them, all the fixed assets. You normally have them here. Put the value for the cost, then you less the net book value, you get the, you less the accumulated depreciation, you get the net book value. The same case applies. The cost for the furniture, the accumulated depreciation for the furniture, if you minus the 2, it gives you the net book value. The cost of the land. Land actually don't depreciate. Land and buildings, you'll find that in most questions, we have the cost of the land, but it does not depreciate. So the cost is the same as the net book value here. So the same case applies to the others. You get the accumulated depreciation, you less, you get that figure. Like that, like that. Once you have done that to the fixed asset, the first 2 columns are not important. So you normally put the double lines like that. But for the net book value, that is the column we are interested in. So you just add all the net book values, you get the total like that. After having the fixed assets, net book value total, you proceed to the current assets. Current assets, we normally have things like inventory. And the inventory that we normally use here is the closing inventory or the closing stock. You put them in the second column. We normally have things like the debtors or accounts receivable. Then you have got things like the cash at bank, the bank balance, the cash. We also have prepaid expenses. You put them there. Remember, the prepaid expense, it's an expense that you have paid, but the actual time for consuming them has not yet come. So you just add like that. So let us use the first format. We have got 2 formats that we can use, but let us use the first format. If you add all these, you can transfer them here. You can transfer them here so that now you can be able to add. You can be able to add with the net book value of the fixed assets. So you add them there so that you can get a figure we normally refer as the total assets. That is the net book value of all the fixed assets plus all the current assets. You get the total like that. And this figure, you put double lines like that. The other thing I want you to remember here, you must put double lines. Once you put the double lines, it simply means that any figure that is going to be entered below these double lines, it is not going to be added with the figures we have above the lines. But if you don't put the double lines, somebody might think that these values that you have here are going to be added with the values that we have on top of the two lines. So make sure you have the two lines like that. So having obtained that, now you can go to the part of the capital and liabilities. Let us do it on the next page. We can have, you can come here and you say financed by capital and liabilities. Start with the capital. You will be given in the question. So you just put the figure, you can put it here. To the capital, you normally add net profit. But if it is loss, you minus. If you got in the statement, in the income statement, it was net profit, you add it here. If it is loss, you minus. In most cases, it's net profit. And then you less drawings. You put it here so that you can get a total there and transfer it here. So remember, drawings is not an expense because majority of students, they normally confuse drawings with the expenses. Drawings should never appear under the expenses. It should be subtracted from capital in the statement of financial position. So you have it there. And then now you can talk about the long term. The long term liabilities. In most cases, it is the bank loan. You come and put it directly there. Then you also include now the current liabilities. The current liabilities are going to be items like creditors or accounts payables, bank overdraft, we have accrued expenses. You include it here so that you can add them, you transfer the figure here. Now, if you add the figure for the net figure for the capital, you add the long-term liabilities, you add the current liabilities, you are going to get a figure here. This figure that you have here should be the same as the figure that you got. Should be the same as the figure that you got under the total assets. Should be the figure that you got here under the total assets, this figure. This figure and this figure, they need to be the same. They need to be the same. If the question was self-balancing and if you have not committed any mistake. If the question was okay and if you have not committed any mistake, the two figures should agree. So with that much explanation, it is time now we do the practical aspect on it. So I will prefer we start with the first question, which is actually the question I took photo and shared on WhatsApp of Guyane Enterprises. Guyane Enterprises, if you can be able to access the question, then the better. Just so the question of Guyane, anytime you are given, the question reads like this: the following trial balance was extracted from the books of account of Guyane Enterprises as at 31st December 2014. So you are given the trial balance. The trial balance will have the debit balances and the credit balances. As you should remember, the assets are going to have the debit balances. The expenses are going to have the debit balances. The same case applies to purchases. Purchases, assets, expenses are all going to have the debit balances. So their figures are going to be on the debit side. On the credit side, we normally have the capital, the sales, and liabilities. Capital, sales, and liabilities are going to be on the credit side. Kindly remember that. Then, anytime you are given this question, your focus, first of all, should be on the additional information which will appear below the trial balance. So under the additional information, you are told, as at 31st December 2014, inventory was 68,000. There were accrued salaries of 350,000, and there were prepaid insurance of 17,000. We had those three crossing balances. And then you are told depreciation on machinery is at 25% per annum on cost. Again, a very important point to note, whenever you are reading a statement on depreciation, note it is a certain percentage on what? Is it on cost, or is it on the book value? So if it is on the cost, you just multiply the percentage with the cost of the assets as given. But if it is on the book value, you must mind minusing or subtracting the accumulated depreciation for the previous year. Then you are told a provision for doubtful debts of 5% of accounts receivable is to be created. And then you are required to prepare the income statement and statement of financial position, both for the year that came to an end on that 1st December 2014. So this question should always start with what we normally call the workings. You do some adjustments using the additional information. The first one is actually the closing stock, the closing inventory, because it is for the 31st December 2014, and the statements we are preparing is 31st December 2014. So this is the inventory as at the closure of the year. So the inventory is valued at shillings 680,000. Then number two, we have got accrued salaries. Remember what we said with accrued. Anytime you are given accrued, it simply means that it is the salary for this year, but as we are coming to the end of the year, this salary has not been paid. So we normally add. Accrued, we normally add. And remember also, accrued, remember the word accrued, they can use the word due. They can say salaries due. They can use the word outstanding. They can use the word arrears, like that. They can also use the word unpaid or not paid. All these words or all these terms, they mean the same thing. That particular amount, it is for this year that we are preparing the financial statement for, but it has not been paid. So we normally add it because it belongs to that financial year. So when it comes to accrued salaries, we normally go and do this. Go to the trial balance. What was the figure for the salaries? From the trial balance, what was the figure for the salaries and wages?
350.
Salaries and wages? Okay, leave around the accrued. From the trial,
Okay.
from the trial balance on top there.
3,548,000.
Remember, 3,548,000 is what we have paid. And then we have these that we are talking about accrued.
Okay.
So we normally add now the accrued, which has not been paid. So the amount that were paid plus what was not paid, but it is for this year, so that we can get the amount for the salaries that were supposed to be paid the whole of the year. This will give us how much? 3 million? 3,898,000. Is it okay?
Yes.
Yes, this is the total salaries that were supposed to be for this period. What was paid plus what was not paid. Then we are told that we have prepaid insurance. So what was the figure for the insurance from the trial balance? How much was paid towards insurance? The trial balance on top there? 60?
60,000.
60,000 was paid, correct? Then we are told that out of this 60,000, there was a prepaid of 17,000. Remember, prepaid simply means that it was paid in excess. We paid in excess 17,000. So 17,000 is not for this year. 17,000 will be consumed the following year, so we less. Any prepaid, you normally less the 17,000 so that we can get the figure that was supposed to be for this year only. It is going to be what?
43,000.
43,000. This is what was meant for this year only. So not here. Accrued, we normally add what was not paid, but it is for this year. Prepaid, we less because it was paid this year, but it is going to be used next year. It is an excess amount. Then we go under, this was number 1. We have, this is number 2, the insurance. We can go to number 3, which is a depreciation of machinery. Depreciation of machinery, we are told, should be provided at 25% of the cost. So you can just go to the trial balance and get the cost of the machinery. Somebody who is there?
2,750,000.
2,750,000. So can you multiply by 25% of that? $0.25 times 2750,000.
687,500.
Sorry, come again.
687,500.
687,500. That is the depreciation for machinery this year. Then number 4, adjustmental working is on the provision for doubtful debt. So the provision for the doubtful debts, we are told we provide at 5% times the accounts receivable. The accounts receivable or debtors. So how much was the value for the accounts receivable? It is 1,450,000. Yes, it is 1,450,000. So can you calculate 5% of that? 1,450,000 times 0.05. Give a figure.
72,500.
72,500, like that. And we are done with the adjustments. Now we can go and prepare our statements as we are directed. I hope you can be able to follow here. The accrued you add, the prepaid you less, the depreciation you look whether it is on cost or the book value. If it is on cost, just multiply direct with the figure that you have been given on the fixed assets. The provision for depreciation here, the provision for provision for doubtful debts. Once you calculate it, you need to go to the trial balance and find out, are we given the provision for doubtful debt in the trial balance? If you look from the top to the bottom of the trial balance, do we have provision for doubtful debt? All the provisions are actually supposed to be on the credit side. If I look at the credit side from the bottom, I see capital and accounts payable, and then I have the return and then the sales. There is no provision. So we normally assume that initially the company or this particular sole trader was not having a provision. Remember, a provision of doubtful debt, it is the amount that you set aside. In case the debtors or the accounts receivables don't honor their pledges, or some of the debtors come or are declared bad, or we are going to encounter what we call the bad debts, this amount that we set aside is going to cater for that. It is something that you put aside in case they don't pay, this amount will cater for that. So we can assume that initially this person or Guyan was not having a provision. So the provision was 0, and now he has set it to be 72,500. And therefore, if initially the provision was 0, and now we have 72,500, then it has increased from 0 to 72,000. It has increased by 72,500, like that. So let us proceed and prepare the statements as asked. So the title here should be Guyana Enterprises. We start with the first statement, which is the income. For the year. For the year ended. The trial balance was 31st Dec 2014. So you have your heading there. It should be at the center of your page. Having done that, you make sure you have got 3 columns for recording the amount, and always start with the sales. The sales was amounting to how much? It is 98,78,000. So you put it here, 98,78,000. And then, do we have the returns, class? Do we have the returns? Yes, we have.
Yes. Returns, yes.
68.
Yes. Another thing there, you need to now remember what we said about the returns. Remember, we have been given the returns, and one figure is on the debit, and the other figure is on the credit. So one figure, it is for sales returns, and the other one is for purchases returns. So you need to note which one is for the sales returns and which one is for the purchases returns. What do you think? The sales returns will be which figure? The one on the debit?
50,000.
Huh?
On the credit side.
Anybody with a different opinion? Okay. Everybody is contented that the return is supposed to be 50,000?
68,000.
68,000. Okay. Anyway, the correct figure is 68,000. Remember, sales and sales returns, they are not on the same side. Sales is going to be on the credit, but sales returns is going to be on the debit. They normally switch. Sales always find it on the credit, but sales returns, you will find it on the debit. So 68,000 is the figure that we are supposed to less here. So if you less that, how much are you going to get? That is actually going to be our net sales. How much is that? Tell me, this is 1,000, this is 0, this is 1.
9.8. 8109. Yeah.
9,810,000. That is what we are referring as the net sales. Therefore, we less cost of sales. And once you write cost of sales, you underline it, because cost of sales, it is not a single figure. It is actually supposed to be derived. Then you come here and you record opening stock. How much is the opening stock? Opening stock, you will always find it inside the trial balance. You are given inventory 1st January 2014. That is the opening stock, 576,000. You put it in the middle column. Then you come here and you say add purchases. But now purchases, it needs to do to get some adjustment. Because it requires some adjustment, that is why we normally write it on the first column first. Purchases is 4067 500. 4067 500. Do we have carriage inwards? You know, this question is just a matter. Once you have the flow, you just look for those figures. Do we have carriage inwards or carriage on purchases?
Yes.
I can see we have Carriage on purchases. And it is amounting to how much? Carriage on purchases?
20,000.
Really?
It's not 204.
204. 204,000.
It is 2.
Okay, yeah, 204.
Okay, okay. Then we less purchases returns. Purchases returns now, it is going to be on the credit side. Purchases is on the debit, purchases returns on the credit side. So you less it is 50,000. You put it in bracket because you are subtracting. Okay, somebody to add for me this one faster. 40,67,500, 40,67,500 plus 204,000 minus 50,000. 40,67,500 plus 204,000 minus 50,000. How much do you get? Yes, please. 40,67,500 plus 204,000 plus minus 50,000.
257,500.
Sorry, come again.
Sorry, I think I've made an error.
Mhm.
Just a moment.
4 million
Yes.
to 21,500.
Uh-huh.
500.
Okay, you add it to the opening stock. This is now the value of the purchases. You add it to the opening so that we can get the cost of goods available. Cost of goods available for sale. What do you get? The figure you have, you add 576,000.
4,797,500.
4,797,500. Then you less the closing stock, which you will find it on the additional information. But at 31st December 2014, inventory was 680,000. So you less 680. You less 68,000. What do you get? So that you can get now what we are referring as the cost of sales.
4 million.
Yes.
117,500.
178.
117,500.
117,500. That is now the cost of those sales. We sold 9,810,000, but those goods that we sold this figure, they had costed us this much. So if you subtract the two, you get the gross. You get the gross profit. 9,810,000 minus 4,117,500. What do you get? 9.
5.
Yes, 5.
692,500.
That is what we call the gross profit. The gross profit is what you get after buying and selling the goods. It is actually an income you get from buying and selling of the goods. Gross profit. Then, after getting the gross profit, remember your statement is supposed to continue downwards, only that my page has come to an end. We come here and we find out, do we have additional or other income? The gross profit is how much? 56,92,500. 56,92. So do we have other income? Other income, you find it or you locate them on the credit side. If they are there, they are always going to be on the credit side of the trial balance. The likes of discount received, rent received, commission received. Those are the major ones. What I can see on the credit is sales, return, accounts payable, capital. There is no any other income of the nature that I've mentioned. So you stop there and come and say, because we don't have additional or other income, we less now the expenses. You also underline because expenses are many. We can go and start with what we did on the workings. On the workings, we had what? We had salaries. The figure was adjusted to 98,98,000. We can come here and start with the salaries, where we have 98,98,000. So we have here shillings. You can come and tell the examiner here, you find it on my working number 1. Number 2, we have got insurance, which was adjusted from 60,000 to 43,000 for this year. So you can come here again, you write insurance. This is my working number 2. And the figure that arrived for this year, we were supposed to pay only 43,000. Then we have got depreciation of machinery. Depreciation of, this is my working number 3. You will find it, and it is how much? 687,500. 6. Then we have increase in provision for doubtful debts. For doubtful debts. And remember, I've told you, if the trial balance, we did not have any provision, but we have been told to provide it. So we assume it was initially 0. Now it has gone to 72,500. So you indicate there as an expense 72,500, like that. I hope we have exhausted the adjustments. Once we have exhausted the adjustments, we go to the trial balance and locate other expenses that don't require adjustment from the top. Make sure when you are preparing this statement, don't mix this statement, don't mix the assets here. We are only supposed to deal with expenses here. We are only supposed to deal with the expenses. So from the top, cash is not an expense, that is an asset. Purchases, we have handled that. Sales, we have handled that. Just a minute. Okay, sorry for that disruption. I was saying that anything that you enter in the expenses, it must be an expense. Don't mistake and bring an asset here. And the assets, we only put the depreciation on those assets which are actually fixed, but we cannot enter the machinery here itself. It is only its depreciation and the other expenses. So cash cannot come here. Purchases, we have sorted that. Sales, returns, salaries and wages, we have the adjustment that was made here. It is sorted. So the other expense is actually electricity. Electricity is an expense, and it is for what is the figure from your end? Are you able to see it well? For electricity.
$47,000.
Is it 47 or 478?
70 what? Is it 3 or 8? Not very clear.
Is it 308? Electricity 470?
Is it 3 or 8? 470. 3 or 8.
It looks like 3, yeah?
Yeah,
Yeah, it looks like 3.
It is 473,000. So you put here 473,000. Then we have got carriage on purchases is the carriage inwards that we handled. Then we have got carriage on sales. Remember I said carriage on sales is the cost of transporting goods for the customers who have bought them. So it is an expense. Carriage on sales. How much? 326,000. Then inventory, we have handled that. Land and buildings, that is an asset. Machinery is an asset. General expenses, so it's supposed to be here. General expenses, 300,000. Then we have got insurance, which we did the adjustment here. Drawings, I insisted, don't make a mistake of having it as an expense. Accounts receivable, that is debtors, is an asset. Accounts payable, that is a creditors, which is a liability. Capital cannot come here. So these are the expenses that we have. Can you add all of them? Add all of them.
$5,800,000.
Minus. So 5,800,000 are the total expenses. You minus from this. So it's going to be a net loss. It is going to be a net loss of how much?
107,500.
So you don't put a negative, you just put it, it's a net loss. You just put it in bracket, meaning it is negative. Like that, and that statement is sorted. The income statement comes to an end once you have arrived at this figure, either the net profit or the net loss. Once you are there, it is done. Important points to remember: under the expenses, don't include assets. Let it be expense. Anything that you spend money on, that is not a fixed asset. Once you get it, it's okay. We can go to the statement of financial position. So the name of the business here is Guyan Enterprises. Then you say this is a statement of financial position. As at, remember the format, as at 31st Dec 2014, you underline. So have a column for you to record the cost of the fixed asset, the accumulated depreciation, and the net book value. So they are in shillings here. So fixed or non-current assets. So for the fixed assets, what do we have? We have got the land and buildings. Land and buildings, which I told you don't depreciate. But sometimes buildings do depreciate, but land don't depreciate. The cost is 3 millions. They don't depreciate, therefore the net book value will remain to be 3 millions, like that. The other asset is machinery, whose cost is 2750,000. Then you less the depreciation that we calculated. We calculated the depreciation of machinery here, which was 687,500. So you less that depreciation, 6. So if you less 2,750,000 minus 687,500, how much do you get? 2,750,000 minus 687,500, how much do you get?
$2,062,500.
Like that. I think those are the only fixed assets that we have in this question. So these two we double underline. Then we put a single line, we total this. This one is going to be 5,062,500. Then we go to the current assets. Current assets, what do we have? Current assets, don't forget to include the crossing stock. The crossing inventory, it is mostly forgotten, of 680,000 because it is still in the business. It has not been sold, it is still in the business, 680,000. Don't forget to include prepaid expenses. So in this case, we have a prepaid insurance of 17,000 because this money is ours. We have not utilized this financial year. Then from there, we have accounts receivable, who are the debtors, they are current assets. And here you need to remember something. What is the figure for the accounts receivable? 1,450,000. You minus the calculated provision for doubtful debt because we are not actually expecting, or we are doubting whether this amount is going to be received. Remember, doubtful debts, they normally arise from the debtors. So 72,500 of the debtors, we are not sure whether they are going to be paid. And because we must prepare this statement in accordance of the prudence concept, whenever an amount is not sure, or you are not sure whether the amount is going to be received, you don't include it. So you raise here 72,500, which are doubtful. 1450,000 is what we expected, but 72,500 is doubtful. Yeah. So how much are we sure we are going to receive? Yes. Subtract 1450,000 minus 72,500. How much are you getting?
1377,500.
1377,500.
Yes.
That is what we are sure of receiving. So you must also be very careful. Once you have calculated the doubtful amount, you must make sure you less it from the receivables, because you are not sure. Receivables is what you expect, and what is doubtful, you cannot be able to include it. Then what is the other current assets that we have from the question? We have cash at bank. So we can include here the cash at bank. There is 17,000. What else? Don't include the opening stock. Don't include the opening stock. I think that is the only thing that we have, unless somebody has noted something that can qualify to be called a current asset. From my end, I think those are the only current assets that we have. Can you add them? Add them. 680,000 plus 17,000 plus 1377,500 plus there is 17,000.
2391,500.
Can you add now to the net book value of all the fixed assets, so that now we can get the total assets?
$74,54,000.
Okay. Your statement is supposed to continue, but because of space, I will go to the next page. Yours just continue downwards. So you normally come here and you say those total assets are financed by, we normally have capital. We normally have capital of how much? How much is capital? 7 million. It is at the bottom of the trial balance. 7,100,000. Then, because we realized the loss, we normally raise net loss. The net loss that we got was of how much? The net loss was of 107,500. We normally subtract the net loss, but if it was net profit, we add 107,500. We less 107,500. Then we also less drawings. And drawings in this case, they were 524,500. We less. Give me the figure for the net capital. $7,100,000. You minus 107,500. You also minus 524,500.
468,000.
Then we normally, do we have any loan here? Any long-term liability like a loan? I can't see. So what we normally have, or what we have in this question, are the current liabilities. We don't have the long term, but if it was there, we could have started with it here. So current liabilities, we have accounts payable, which is 630,000. Let me put it here so that we total fast. 630,000. We also have accrued. Remember, accrued is what has not been paid, so it is a liability, it's a debt. Accrued insurance, salaries. Accrued salaries, they have not been paid, which is they are amounting to the 50,000. Do we have any liability really? No. So can you sum the two? Sum those two.
980.
Sorry, 980. So they are coming to 980,000. If you add to the net capital, what do you get?
Seven 448.
7,448,000.
Yes.
And here we got 7,454.
454.
Then it simply means that either the question was not correctly set, or there is a mistake we have done there, but I can't see the mistake, or unless these figures that we are struggling to see, they are actually not giving us a true picture. But that is how we normally do it. Unless, or somebody has seen where we made a wrong addition or a wrong subtraction. So it is supposed to balance. Actually, this figure for the total assets here, this figure for the total assets, and the figure for the liabilities and capital, they are supposed to be the same. They are supposed to be exactly the same. I want us to look at one CHRP question. One CHRP question. And we see whether it is going to balance. I'm interested on which one. I had indicated some questions that we shall do on WhatsApp. Which one and which one? There's that question for CHRP, which year? 2019 November. 2019 November, question 6. Are you able to access it? Are you able to access that question? I know now it's going to be clear. Let's see. Are you able to access it? It is going to be a bit difficult if I have it, but on your end you don't have it. It can be challenging. Can I leave it to you? You try. Hello?
William, you said which year?
2019 in November. Question 6. It is going to
I'm
be
trying to check.
question 6, which talks about the Mutusa traders.
Yeah, 2019
Yes, found
November.
it.
Yes,
Yeah,
Yes.
you can be able to get it.
we found it.
Okay. So that question, the question was requiring you only to prepare the statement of financial position, because in the question you have been given the figure for the net profit, so they have prepared the income statement for you. So you proceed and prepare this. So I want us to do that question. And as I've said, always when you are given these questions, you go to the additional information and you start with the workings. Start with the workings. Number one, additional information number one talks about depreciation. So our working number one will focus on depreciation. And we are told that land depreciation is to be calculated as follows. Land and buildings at 5%. Land and buildings it is 5% times the cost. 5% on cost. Land and building. What was the cost of land and building? 20M. So somebody should calculate this one for me. Then we are given for plant and machinery. Plant and machinery, you have been told it is 6% on cost. So you do this one should be 6% times the cost of plant and machinery, which is 15 millions. You get that. Then we have got a depreciation on furniture and fittings. Furnitures and fixtures, sorry. And which you are being told you calculate at 4% times. Now you have been told it is not on cost, but reducing balance. Once you have been told it is reducing balance, then you must minus the cost minus the accumulated depreciation. So what is the cost for furniture and fixtures? The cost is 7 millions. You minus accumulated depreciation. And that is what we have been given below there. Once you have been told furniture and fittings at 4%, reducing balance, below it you have been told the accumulated depreciation. The accumulated depreciation as at 1st January 2018 for furniture and fixtures was that. So that is the figure that you need to use in subtracting here. The cost of these furnitures was 7 million, but as at the beginning of this financial year, already they had lost 1054,574. 574. So you minus the accumulated depreciation so that you can get the net book value. Now you can multiply the net book value by the depreciation percentage. So you need to do that also, so that now we can be able to calculate all the depreciation. And lastly, it is the motor vehicle, depreciation on motor vehicles. For the motor vehicles, you have been told it should be calculated at 12% on cost. So you just go directly and get the cost of the motor vehicles and get the cost of the motor vehicle, which is 5,600,000 like that. So you calculate that and you get it. Are you able to get those figures? Anybody with any figure?
The first one is 1 million.
1 million. Anybody who has calculated the second?
900,000.
900,000, thank you. The third one, you minus this and then you multiply by 0.04.
to 37,817.
The last one,
672,000. Maybe someone else can confirm. If it is okay.
is anybody who has derived a different figure from the 4? Okay. Having done that, remember the depreciation is very simple. You just note whether it is on cost. And that's why when we are doing the depreciation, I told you the straight line and the reducing balance method are extensively used in the examination question. If you are told it is on the book value, then it is on reducing balance. If it is on cost, then it is straight line. You just calculate directly on the cost. If it is told on book value or using reducing balance method, then they must give you the accumulated depreciation, which you must subtract from the cost, and then now you multiply by the percentage. This one will be given to you. So you must purpose to minus first before you multiply by the percentage. Then additional information number 2 talks about prepayments. And we know prepayments we normally add. So the first one, it is the prepayment of insurance. This is the working number 2. So first of all, you get the figure for the insurance from the trial balance. Do we have the figure for the insurance? We are not actually been given, but this is prepaid. It is actually not going to be important because the income statement has already been paid, but we need to note that we had a prepaid insurance of 300,000. It is actually a current asset. This is a current asset to the business. Then we have the prepaid rent, which was amounting to 460. All the prepaid expenses, they are current assets. So when we shall be having the list of the current assets, we must include them. Then number 3 is about accrued salaries. Remember that is a current liability. Accrued salaries, which was amounting to 350,000. This is a current liability. The provision for doubtful debt is at 5%. Number 4 is provision. Which we are told it is going to be 5/100 times the accounts receivable. It is always on the accounts receivable. How much are the accounts receivable from the figures that we have been given? Accounts receivables, they are third from top.
3.5.
3.5, yes. So you get 5% of them. They are actually doubtful. It gives us how much there? %5 of 3.5 or 3.5 times 0.05.
175,000.
Sorry?
175,000.
175,000. Then we are told that the business has been in existence for 5 years. Are we going to use it anyway? Anyway, let us now prepare the statement of financial position. So the name of the business is Mutusa Traders. Statement of financial position as at, we are told to prepare as at that first deck, 2018, and you underline. That is sorry, that is actually the point where you earn the first mark. But actually, all the workings that you have done, they will earn you some marks. So underline it like this. So we can start with the fixed assets. And we said have a column for recording the cost, accumulated depreciation, and the net book value. So what is the non-current assets or fixed assets that we have? Number one, we have land and buildings. Land and buildings, the cost is 20 million. The accumulated depreciation, the depreciation that we calculated for the land and the buildings was 1 million. So we subtract 1 million. Sorry, there is a one point that I was almost forgetting. That last additional information, the business has been in existence for 5 years. The business has been in existence for 5 years. Now, I've seen where we need to apply that statement. Remember, if the depreciation is on cost, this 1 million, it is the depreciation for only this year. It is the depreciation for only this year. And if the depreciation is on cost, it simply means that each and every year, the depreciation is 1 million. Each and every year, the depreciation is 1 million. Therefore, if we talk about the accumulated depreciation, it is the depreciation from when the business started or when these assets were acquired up to date. Since the business has been for 5 years, therefore, the total depreciation would be 1 million for each year times 5 years. So the accumulated depreciation here should be 5 million, not 1 million. I think that is the point maybe we could have forgotten. Depreciation on cost, it simply means that the depreciation is constant. So each and every year, the depreciation was 1 million. For 5 years, it is supposed to be 5 millions. So if you subtract the cost, they were 20,000. They have lost 5 million for the 5 years. Therefore, the net book value for these assets is supposed to be 15 millions. Go and do the same to the next asset, which is plant and machinery. Plant and machinery, their cost is let me look at it. The cost
15 million.
Yes, 15 million. What was the depreciation per year for this?
900,000 per year.
Times 5 years. 905.
4.5.
4,000,005.
4.5.
Yes. So this means that they are going to have a net book value of how much? 15 million minus 4.5.
10,500,000.
Like that. We go to the next asset, which is furniture and fixtures. Furnitures and fixtures, the depreciation per year, ama hiyo ilikuwa ina depreciate on which basis? It was actually the reducing balance. This one we cannot multiply by 5 because we were given this 1054,574. It was the depreciation for the previous year. It was the accumulated depreciation from year 1 up to the end of year 4. And then we have calculated for year 5 here. Therefore, the total depreciation for fixtures and furnitures, it is 1054,574. Then we add this. I beg there, I repeat, the 1054,574, it is from the beginning of the business up to the end of year 4. And now for year 5, this is the depreciation. So we add this plus this for us to be able to get the total accumulated depreciation for these assets. So 1054,574 plus 237. Come again.
It's 1292,391.
1292,391.
391. 91. Yeah.
Now the cost
That
of,
is 1054,574.
yes, plus,
Mwalimu.
yes,
Okay, 1054,574 plus 237,817.
You get this,
It gives us the, yeah.
that is the accumulated depreciation. So we need to capture the cost, which was 7 million. The cost of this is 7 million. So if you subtract the two, what would be the net book value? It's going to be 5 millions.
5 million,
Mm-hmm.
707,
Mm-hmm.
609.
Okay, then we go to the last assets, the last fixed asset, sorry, which is motor vehicle. It was depreciating on cost. So you multiply this 672,000 times 5 because the depreciation was constant for those 5 years. 672,000 times 5. How much are you getting? The cost is 600,000.
3,360,000.
If you minus from 5,600,000, what do you get? You minus from 5,600,000.
$2,240,000.
Okay, now can you add for me all the figures for the net book value? Add the net book values: 15 million, 10,500,000, 5707, 609, 2240,000, 2240,000. If you add them, you get how much?
$33 million,
Mm-hmm.
447,
Mm-hmm.
609.
Okay, thank you. Now we can come here and capture the current assets. The current assets. So we have the accounts receivables. Here we need to be careful. The accounts receivables, they are 3,500,000. We minus the provision. We must remember to minus the provision, which we calculated here. 175,000. 175,000 worth of debtors are doubtful, so we minus so that we can get the value for the debtors we anticipate to receive from them. Subtract for me that 3.5 minus 175,000. Yes.
3325.
325,000.
Yeah.
Then what else? We have the bank balance, but bank is supposed to be recorded last. Let us look at the prepaid expenses. They are current assets. So the insurance and the rent that were prepaid, because we have not utilized this money, it is our money. So we put it here. So we have a prepaid what? Insurance. Prepaid insurance was 300,000. And then we also have prepaid rent, which is amounting to 460,000. What else are we given? We have the bank balance, which is 970,500. Then we have the cash box balance, cash in hand, 21,500. I think we are done. Unless somebody can spot any current assets. It's normally the receivable, the prepayment of expenses, cash bank. Inventory we don't have. If there is none that is left out, you can total this. This is 21,500. Can you total them so that you can know the total current assets? How much? This is 3,325,000 plus 300,000 plus 460,000 plus 970,500 plus 21,500. If you total them,
5,077,000.
5,077,000. Can you add now to the net book values of the non-current assets or fixed assets, so that now we can get the total assets figure? Give me.
38, 524,
Yes,
609.
609. Okay. But I have, do we have inventory? Did we include inventory? Number 2 from the top. The following balances are from the books of goods. They are all for the year ended that was actually supposed to be here. So this figure is not right.
Inventory. Okay.
Inventory should be included as a current asset. Let me see. So just add that figure. The figure we had for the current assets, but I will just we include inventory. This was 21,500. We include inventory. But when you are writing, make sure when you are preparing your statement of financial position, these two should appear last. Inventory should have come on top of them because it is more fixed. It is actually going to remain in the business more than them. They should always be the last current assets. But let me insert it here. It is 52,391. 52,391. So if you include it, how much now do you get? 52,391. You add now plus the others. 52,391 plus 21,500 plus 970,500 plus 460 plus 300 plus 325,000. What is the total?
$51, 29,391.
Sorry?
51,
Uh-huh.
29,391.
Come again, please. 51, 20.
5129,
Uh-huh.
391.
Okay. Can you add now to this figure for the net book values of non-current assets?
38,
Yes.
577,000.
57.
7,000. 7 again and then 1,000.
Okay, those are now the total assets. Now we can go now and see on the financed by part. Capital. How much was the capital?
$29,327,000.
29,327,000. We add, in that period, did they register net profit? We are given.
Yes. Net profit for 31st December.
Yes.
8,650,000.
Did the business have any drawings?
Yes.
You less. You less the drawings. The drawings were how much?
4.4.
400,000. So what is the figure for capital there? Then you can see 29,327,000 plus 8,650,000 minus 400,000. Yes, tell me. Do you have the figure?
23,577.
23?
53.
Oh, sorry,
Sorry. 3,577.
just a minute. 3,
577,000.
577,000. So
Yes.
the current liabilities, we have the accounts payable. The accounts payable was amounting to how much?
Accounts payable.
4650. Yeah?
Yes.
4650,000. What else is a current liability? Let us confirm from the top: land, inventory, accounts receivable, bank, plant, cash, capital, net profit, accounts payable, drawings. Then I think the accrued salaries. Anything accrued is a current liability. Accrued salaries of 350,000. Do we have anything else? I don't think. Can you include this so that we can see whether it is actually having the same total?
Yeah, it's balancing.
Is it balancing?
Yeah, it comes to 38,577. Yeah.
1,000. So that is how it's supposed to balance. If the question is well prepared and you also don't make any mistake, it's supposed to balance. So this was 38. I put it, I had indicated as 28. It's supposed to be 38. Okay, yeah, it's supposed to be 38. This 5. That is actually how it is supposed to be done. And you get your 10 marks. But the good thing with accounting, the final answer is not everything. You can mess somewhere and you still get your 8 out of 10 marks or 7 out of 10 marks. Entries matters. Just make as many correct entries as possible and you end up getting good marks for that particular paper. So I want to end the class at that point, but you are free to ask for any question or clarification. Anybody with a question? Okay, if there is none, then allow me to end the class at that point, and I congratulate you for your attendance. We shall meet next week, and God willing, I want us to do the two statements that are remaining for the partnership and for the company. We can do them using that lesson. I hope we can be able to cover that. Now that you have understood the procedure that we undergo here, what is going to be the difference is the moment we get the net profit, we are going to include a very small portion, what we call the appropriation. The appropriation, how is that net profit now going to be shared? For the partnership, it is not one person. If we have got 2 or 3 partners, they need to share that profit. We need now to include how the profit is going to be shared, which is the appropriation. The same case to the company, we need to show how much will go to the taxes and the dividends and all that. God willing, I want us to do it so that if a small portion is going to remain, we finish on the other week. And then we can start on some revision. But if I can look at the questions that you have for HRP, they are not hard, but it's like there is one topic which is not in your syllabus, but they normally test. That is on the ratios, the accounting ratios. It simply means we need to go an extra mile and do what we normally call the financial statement analysis, and we do the ratios in one lesson so that you can be actually all around. You can be able to tackle any question that comes your way. So let us meet next week. We cover the remaining portion, then we spare sometimes, we cover the ratio analysis, and then we can do some revision before those who shall sit for the next December will be well prepared. Any question? Okay, if there is no question, please allow me to end the lesson. And thank you very much. Have a blessed evening and also a very fruitful week ahead.
Thank you. Thank you.